Hi guys, and welcome to another technical analysis lecture in the Atlas Blueprint. Now that we're really getting into the meat of technical analysis and what we look for when we come to analyze the charts and look for entries on specific pairs, we want to take a deeper look into order blocks. Now, order blocks are a specific candle that we look for where we can see where an institution initiated a move. Okay, we can call them big player stacks, we can call them order blocks, points of entry. The actual idea of this candle or this pattern has many names, but as order block being the most common, we'll stick with that for now. The reason I like order blocks is you can identify the start of a move. So, if we see price absolutely rally or we see price free fall, we can always look to the beginning of that move for a potential return to origin later in the day, later in the week, later in the year. Order blocks are temporal, so they occur across every single time frame. You'll find order blocks on the 1 minute, you'll find order blocks on the hourly, and you'll find order blocks on the daily and the weekly, etc. This specific area shows heavy pressure on the buy side or on the sell side, and that's how we know that's where the big guys got off their orders. So whether it's the central banks, the hedge funds, the institutions, that's why we identify these order blocks so that we can use these to help us spot a reversal. So I'm going to go through a few examples, show you what they look like and what we look for a valid order block, and how we can utilize them for really good entries on trades, how that we know that price is going to turn, and how that we can forecast future direction of price. So I've left some analysis on my chart because I think it'll be easier for you to understand the order blocks I'm looking at. So the very first one that stands out to me here as a rather large order block is this swing up here. So we take liquidity above this high, which is a move created by the big guys, created by the institutions, to run into this area of high liquidity, which is also an old order block up here, but we'll get into that in a moment. Now, the order block we tend to refer to the last candle that goes against the initial move. Okay, so the initial move here after this run on liquidity is a move to the downside. So the last candle is the order block candle, is the last one that pushes to the upside, because that's where the institutions who force this move into the liquidity begin entering out of their longs in this example. They'll stop hitting the bid and they'll start hitting the ask. Okay, and that's where they offload their initial order that they won. So when price is down here, they might be wanting to short. This is euro dollar, so they might be wanting to short euro dollar. So what they're going to do is they're going to force market structure higher, run into liquidity, and that's where they're going to offload their orders as everybody else starts trading a breakout and as other people get bullish. That's when they offload their shorts. Okay, and then we see this big move to the downside where we actually break various points of market structure on the way down, even to the lowest point of the most recent market structure, which actually forces a new lower low, which then gives us further confirmation for further downside movement as we come back and sort of test this high area. Now, the reason we look at these last candles is because institutions, central banks, algorithms, etc., they trade with a high amount of capital. They're not trading 1 lots, they're not trading 10 lots, maybe not even 100 lots. They could be trading more size and more capital than we can even bear to imagine. Now, what that means is if they was to short down here, they most likely would get slipped on the way down. Now, slippage is a term when you enter the market and you actually get in at a different price. So let's say price is here. What does this candle open at? So the candle opens at 118.606. If they then offload millions or billions into the market on this candle, their average entry would probably spread somewhere around here. Okay, so they would get slipped through this point. So some of they would offload some of their orders here, which would push the price down. Offload some here, offload some here, etc., etc. There's not enough liquidity in the market. So that's why we see these push on liquidity, run into previous highs and previous lows, to take all the sell stops and buy stops, to force that liquidity for them to enter their original intended direction, which in this case will be short. Now, the last point of where they force the market in the opposite direction is the order block. So in this candle, as our example for this. Now, as price comes down, what we want is a valid market structure break. So it breaks a fractal low here, which is quite nice. We've got a low here, some lows here. And by this point, you know, I would definitely, especially with 2 candles, I would say market structure is definitely broken. We're now falling to the downside, and my next area of interest will be this low here, which actually, you know, gets taken on over the next couple of days. Now, you might be thinking when price is down here, you might be thinking price will never get back up there. You know, we've free fallen, we've come down. Let's check how many pips price falls from the absolute high to the absolute low. Is over 100 pips. So you might be thinking, okay, you know, I'll stick a Fibonacci on that. We might get a 61.8. Might get a 61.8 rejection. You know, we've got a trend line, etc., etc. If you read analyze like that, but we know that the order block was up here. So for the institutions to get out at the best possible price and to get back into the market at the best possible price, they're going to push price back up to their order block, because they want to get in as high as possible when they're shorting, and they want to get in as low as possible when they're actually buying up an asset. So quite often we see what we call an RTO, which is a return to origin. So it's just the return to the origin of the original movement, which is to the downside. So as price is coming back up here, but my first point of sort of looking would be the breaker candles. So these that force the market structure break to upside to take the liquidity. If we don't see a rejection there, I'm then turning to the order block. You can trade the zone as a whole if you wish. That's what I recommend to beginners. But as you get more advanced, you can scale in on the lower time frames, have a look what the order block looks like on the lower time frames, and you can then use your discretion to actually decide where you're going to enter. But the order block is, you know, the best, most favorable entry that you'll probably get. So say for this example, we're trading the order block, but I stop above that high, because if this high gets taken out, our idea is now invalid, and we're most likely going to go and make a higher high. Okay, so our stop needs to be exactly where we are wrong, which is just above this order block, with that entry on the order block. Hopefully you'll be trading with a broker with tight spreads. So if you're funded, you know, with FTMO, you get super tight spreads, especially on EU, usually about 0.2, 0.3. So you most likely would have got tagged in this. But if you're trading with massive spreads, this trade, for example, you probably wouldn't have been. Well, no, I think it would have been maybe. Let's just say we set our target down here at this previous lower low. Now look at that. From this order block, you could have grabbed a 6.5 hour trade. Granted, it's not all downside movement, so if you'd move your stop into profit at certain points, you'd have probably got taken out as price comes back up. So create more liquidity. We can see we have a little liquidity run up here. So we'll run on this previous high. So we have a little liquidity run there before price then free falls, which would achieve our target of the most previous lower low. Okay, so hopefully you understand from that little example what an order block is and how you can sort of highlight them. So just after the market structure break, we look to the origin of the movement. So here I would take this candle at the top to be our order block. Now I did say earlier it'd be the last candle in the opposite direction of your intended trade. But for me, because this candle wicks higher, I'll just class that as the order block. It's sort of discretionary. You can have it, you know, as that candle for your entry, and then I would always take into consideration the highest point for your stop loss. So as we come down and break market structure, which is here, so we wouldn't have got in on this retest, you could trade the order block here. Again, stop above the high, and again targeting the last lower low. So you can see what I'm looking for, and you can see that they work quite effectively. Now you can get these completely wrong. The order blocks don't work every single time. If an institution has changed their mind on a position, they may take profits. They may not retrade their original order block, but more often than not, I want to say, you do see a return to origin of the order block, and you see more institutional buying or selling. Now we should have some more examples over here, let's take a look. Okay, so we see this order block actually has a little bit of a reaction further along, but then we fail to make a lower low. So for me, I'm going to be skeptical as price comes back up, especially after this second rejection from this order block candle area. I'm going to be skeptical about trading this on this actual retest because it looks like price wants to go for that run on liquidity again, because there's not enough selling pressure to keep price falling down. Okay, now here's a nice example of where an order block doesn't get retested. You will see the last up candle here before this break of market structure, and you can see price just hasn't got back to this zone. However, what we can do is in the future, we can keep this zone marked out, okay? Because what you might find is that over time, price starts chopping down and up, and then it comes up, it touches into this zone, and that could act as a form of resistance. And then if we have a break in market structure to the downside, that's when we can start looking at taking a position, okay? So this is where trading things like order blocks and zones of business starts to get a little bit discretionary, because of the time away from this order block, I wouldn't trade that blind. What I would want to see is, even on a lower time frame, if we scaled in on the 5 minute on this in this order block would give me enough high time frame buyers to begin having a bias for the day. So let's say we trade up into this in the morning, we form a high in the Asian session, break below, take the high upon new London opening, but we see a break of market structure. I would then look to potentially trade the order block of this move. So as price comes back up, and then we take that low, and that's where I'd be looking to offload my position. We have enough confluences in that area due to spotting the institutional moves and the institutional liquidity to take a position on that. But you can see, let's take a look up here, because there should be some more examples up here. Okay, so this is a beautiful example. So we have a run up above all these highs up here to take the liquidity, then we then break market structure to the downside. So we take all these lows, take this low before a return to origin. Now the origin of this move is this order block, and then again we get a perfect respect of that order block before price then has a further move to the downside. Let's take a look at a couple more examples if we can find some. Here's one that doesn't get respected. Sometimes the move is just too far in one direction for price to actually come back up and retest an order block. Sometimes it might react on an OTE of a 61.8. Sometimes it might react to the breaker candle, which we can see actually it does here. The breaker candle is this, which forces the liquidity run. We then break below, and we actually get a nice respect of this breaker candle when it comes back up twice. That's another topic of another candle anatomy. Let's take a look. There is one here. So again, the last up candle before we move lower. Break and market structure is here, close below this market structure. And then we get a retest of this order block where they offload more of their orders. This looks to me like it was on news. I think that might have been NFP or FOMC. Most likely FOMC because it's 7 p.m. So we get a retest of the order block a few hours before the FOMC meeting minutes come out, which can give us an indication of how the fundamental news release is going to go later on in the day. Because we've got to remember, institutions, hedge funds, central banks, although they might not know the actual statistics of what a certain data is going to be, they have a pretty good idea. They have information that we don't have access to. Now, they won't have actual insights to physical numbers and physical data because that would be insider trading, but they have reports that we don't have access to, and they do see things that we don't see. So they can gather their position, and it can just be experience. They can see these moves time and time again, and they can begin to hedge their bets. They can think, okay, FOMC, they're going to say X, Y, and Z, so I want to short the euro against the dollar because I think the dollar is going to rise in value upon the release of the meeting minutes. So they'll begin building their position throughout the couple of days leading up to the FOMC. So you can see they into the first position. leave an order block, which is sort of their footprint in the market. Okay, so break a market structure, we have a return to origin right into the order block before we see a rejection here, and then a few hours after we see the news release, and bang, the institution that forced this move or that got their order in before the news, they was early to this move. Okay, so anybody who shorts upon the news release, they, like I said earlier, they're going to be getting slipped here. Sometimes they might have sold at the top, but because prices move so fast, their entry is actually at the bottom. Okay, so they might have to exit out of their positions like pretty much instantly. So although it's higher risk taking the positions up here, you know, before a news release, they do, and we can see their footprint in the market by just marking out their order blocks and the market structure beforehand, and which can give us, like I say, an inclination to which way the news release is going to go. That's more of a concept called pricing in. Okay, where we see institutions and banks pricing in data pre-release, like I say, based on their experience and based on knowledge that they have, and statistics that they have, reports that they have that we don't have access to. Now, if you see their footprint in the market before a news event, you can sort of tend to tell, you know, over time, you can build up experience yourself of seeing which way you think the news is going to go based on the market structure beforehand. But that's the basics of order blocks, and there's not really much to go into in any further detail. Like I say, it's the last move before a market structure break in the opposite direction. But I've given you enough examples that you should be able to recognize these. I think I've already highlighted that one actually. You should be able to recognize these in the market. And what I would do, a good exercise for you to do is to go through on whatever time frame you prefer and just highlight your order blocks and just have a look at how price respects them in the future. You know, remember to look for your market structure breaks. We'll just take a look. Let's find one down here. So that's maybe there. So you can see, obviously, this order block we get respected. This order block we get respected. This one would actually be traded through. Okay, so this one, if you'd have traded this order block, you'd have been stopped out. But then if you'd have traded this one up here, obviously you could have got a couple of entries. And then this one looks like it might want to come back down into this area of liquidity. So just go through your charts and just have a go at marking them out. Once you've started spotting order blocks, it tends to get pretty easy pretty quickly, because your eyes will sort of gravitate towards that as you come to analyze your charts in a live scenario. For example, obviously we can see this order block here. My eyes just sort of get drawn to it over time, of like sort of looking at them and highlighting them. And order blocks don't get invalidated, as you can tell in this example. They're not always invalidated after a first touch. We can come back up and have a retest. And quite often, I know there was, let me see if I can quickly find it on EU. So I found an example. Again, I think this was 7 p.m. on a night, so it could have been FOMC meeting minutes, or a speech from Jerome Powell, or anything from the US side of things. But I remember this specific example because I was looking at this order block on the hourly. I think I was actually scaled in on the 15-minute at the time when I was looking at this. This is back in April of 2021, and obviously we kept seeing price respect this order block, taking liquidity each time before breaking market structure to the upside. Now it comes to 7 p.m. on a night, and we'd actually had a nice market structure and break away from this order block. Now, if we look at the next candle, price spikes down pretty sharply. Let's see, we'll drop down onto the 15-minute. So if you look at this 15-minute candle, obviously we look like we're ready to pop, and then bang on news, you can see 7 p.m. candle straight into the order block before price offloads and moves to the upside. Okay, so you can see obviously there's clear liquidity here, there's clear buyers down here, there's people watching this area, and then you know, price just spikes into it before moving to the upside. So when we're looking at order blocks and areas that we're looking to do business in general, don't ever think it's too far away, because all price needs to do quite often is to spike into it, literally wick down. See if we can jump down another time frame so you can see it's yeah, it's a 5-minute candle, so it literally jumps down within a few minutes. I'm going to try and jump down to the 1 minute, but it sometimes TradingView, if it's too far in the past, it doesn't hold this data, so it might error. Yeah, so this data is unavailable. But yeah, I hope you take some value from that anyway. I know order blocks, it's pretty difficult to get your head around at first, but trust me, once you start spotting them, when you start playing through charts, you haven't got to place your P&Ls or do any specific back testing. Just learn to spot them at first before you actually look at starting to back test and build a strategy around it. Because once you've spotted them, you'll understand what they are and what they mean and why they're left there, and then you can build your strategy around that, rather than saying, okay, I know what an order block is now, so I'm going to start trading every single one that I see. Remember, behind every strategy, you need context. So we need to see preferably higher time frame bias. We want to see strong institutional selling or buying, which we can outline with a market structure break and sharp moves. And then we want to see a return to origin. Now, if we have a return to origin and you think this is completely against current market sentiment, I don't understand why pound dollar or euro dollar is flying when the dollar is actually pretty strong right now. Maybe price is coming back up to an order block or to a zone where the clever investors, the hedge funds and the financial institutions, maybe they're pushing price and manipulating price back into an area of their demand, i.e. an order block, somewhere that they actually want to buy or sell at. When you start looking at this and you start understanding the context and the psychology behind these big players and how they want to get the best price, all the time, you'll be able to build a strategy around that. But order blocks is, in my opinion, super important to understand and to utilize and to get them incorporated in your trading plan. So that's everything that I want to go over. So I'll see you in the next video.